You hear about them all the time, right? Hedge funds. They're mentioned on the news, in movies. They're this huge, mysterious force in the world of finance. But what do they actually do? Well, today, we're going to pull back the curtain and figure it out. Let's get into it.
So just to get a sense of the scale we're dealing with, let's start with one single massive number. As of early 2024, hedge funds around the world were managing over $5 trillion. To put that into perspective for you, that's more than the entire economy of most countries on Earth. It's a staggering amount of money, and it's all moving markets. So a number that big leads to a pretty simple question. We hear the term constantly, but what exactly is a hedge fund? You'd think there'd be a straightforward answer, but honestly, it's kind of tricky, and that's exactly what we're here to break down.
To solve this trillion-dollar mystery, we're actually going to start by defining a hedge fund by what it's not. It sounds a little backward, I know, but it's probably the best way to really wrap your head around their unique spot in the whole financial universe.
And here is the absolute key to understanding them. In the US, hedge funds exist in a special category, mainly because they aren't mutual funds. See, mutual funds are for everybody. They're public, which means they're heavily regulated. Hedge funds, on the other hand, get to avoid a ton of that regulation by being private and exclusive. And that gives them a kind of freedom and a level of risk that a regular mutual fund just can't have.
Okay, so let's put them head to head. Mutual funds? They're for the public, they're highly regulated, and they tend to stick to simpler strategies. Hedge funds? Totally different ballgame. They're private pools of money for wealthy or accredited investors. And because of that exclusivity, they can use all sorts of aggressive tools like leverage and short selling, which is just a fancy way of saying they bet a stock's price will go down. And they can do all this with way fewer rules about telling people what they're up to.
Now, let's talk about maybe the most famous and definitely the most controversial part of the hedge fund world, how they get paid. It's a model that's been around for over 70 years, and it has defined the entire industry. It's known everywhere as 2 and 20. It's a two-part fee structure that has, no exaggeration, made hedge fund managers some of the richest people on the planet. So how exactly does it work? The first part is the 2. This is the management fee. It's usually 2% of all the money they're managing for you. But here's the kicker. They get paid that 2% every single year, whether the fund makes you money or loses it. It's a pretty big price to pay just to have the manager cash. Then you have the 20. This is the performance fee. If the fund actually makes a profit for its investors, the manager gets to keep 20% of those winnings. The whole idea here is that it lines up their goals with the investors' goals. If you make money, they make a lot of money.
And the story behind that number is just incredible. It turns out the guy who started the very first modern hedge fund, Alfred Winslow Jones, he needed a model for this fee. And he didn't look at other banks. He looked back thousands of years to ancient Phoenician sea captains. They used to keep 1/5 of the profits from a successful voyage. And just like that, an ancient maritime rule became the foundation of modern high finance. Wild, right?
So how do those fees really look today? Well, 2 and 20 is still the classic model, but the average is a little lower now, though it's still incredibly high. Your typical hedge fund is charging about 1.36% for management and then a 16% performance fee. Now compare that to an actively managed mutual fund, which charges less than 1% total. You can really see just how expensive this club is. So, what are investors getting for all those fees? That brings us to our next stop, taking a peek inside the black box of hedge fund strategies. This is where things get really complex and really interesting. Generally speaking, you can sort of lump most hedge fund strategies into 4 big buckets. First, you've got global macro, which is all about making big bets on economic trends, like interest rates or currencies. Then there are directional strategies. Think of it as a super aggressive, high-octane version of stock picking. Next is event-driven, where funds try to make money off of big corporate events, like a merger or a bankruptcy. And finally, you have relative value, which is a super complex strategy that tries to profit from tiny little price differences between related things. Okay, that sounds like a lot of jargon. So let's make it real with a really common strategy called merger arbitrage. Let's say company A announces it's going to buy company B. A hedge fund might jump in and buy shares of company B, the one being bought, and at the same time, short sell shares of company A, the buyer. They're not betting on the whole market going up or down. They're making a very specific bet that this one deal is going to happen. It's a simple idea, but you have to be an expert to pull it off. All of this complexity leads us straight into the great debate about hedge funds. Are they really worth all the costs and all the risk? Let's take a look at the arguments on both sides.
Okay, the biggest argument for hedge funds is pretty simple, the chance to make huge returns. Because they have fewer rules, they can use tools like leverage, which just means borrowing money to make their bets even bigger, and really complex derivatives. This lets them hunt for profits in ways that are just totally off limits for a regular mutual fund.
But the argument against them is just as powerful. Those potentially huge returns come at an extremely high price. In fact, a 2023 academic paper found that over a 20-year stretch, fees ate up over 60% of the total profits that hedge funds generated. Let that sink in. A lot of the time, the real winner in the hedge fund game isn't the investor. It's the manager collecting those fees.
Another big pro is diversification. A lot of hedge fund strategies just don't move in sync with the stock and bond markets. What that means is they can potentially make money even when everything else is crashing. They can be a valuable cushion when the markets get rough.
The downside of all that fancy strategy, though, is a real lack of liquidity. You can't just sell your investment in a hedge fund on any random Tuesday. Investors often have to agree to lockup periods where they can't touch their money at all. And even after that, you can usually only ask for your money back once a month or even once a quarter. Your cash is effectively tied up. So, you might be thinking, okay, this is a high-stakes game for the super rich. Why should I care? And that's a perfectly fair question. Which brings us to our last section, why these exclusive funds actually matter to all of us. And when we say exclusive, we mean it. To get into a hedge fund, you usually have to be an accredited investor. That means you've got a net worth over $1 million or a really high income. And for the even fancier funds, you have to be a qualified purchaser with at least $5 million in investments. So yeah, this is not a game for the average person.
And that really is the final takeaway here. Even though hedge funds are private clubs for the ultra-wealthy, they're so huge and their strategies are so aggressive that everything they do sends ripples across the entire financial system. They're a powerful, often invisible force that shapes the markets we all depend on. So the big question that's still being debated is, are they a good thing that makes markets more efficient? Or are they a high-risk, high-cost gamble that puts us all at risk? It's a debate that's not going away anytime soon.